Welcome. This video is on the capital stack, is part of a series of lectures on corporate real estate or commercial real estate investment value. So how much is a property worth to an investor? This is the first in this series, so let me just quickly go over the objectives in investment value. We want to understand the capital stack. That's this video. We want to understand how to analyze debt cash flows. That's the important addition that we're going to learn about in this module. Then we want to know how to start with NOI. So before you watch this video, you need to know what NOI is. Subtract off the debt cash flows that we find in that second objective. The result is what we call equity before tax cash flow. That is an important cash flow line in a pro forma to a real estate investor, and that's where the investors are going to make some decisions on which project to take on. Just another example of what I just spoke to. So before now, you should know exactly what NOI is, net operating income. When we get into investment value, investors differ in their decisions on how to take on debt. So that gives investors a diverse range of potential strategies. There'll be a short video on investment strategies. But what we're looking at here is NOI is meant to show what a property earns irrespective of who owns it. When we get to equity before tax cash flow, which is where investors start having hurdle rates and being able to choose specific projects, that's where investment decisions and strategy differ. You can go all cash, you can take on lots of debt, you can take on a little bit of debt. Those equity before tax cash flow returns are going to be different depending on that strategy. So this is why we call it investment strategy. Later on in this course, we'll talk about tax strategy, which can also differ from investor to investor. So why do investors take on debt? Well, the most obvious one is they don't have enough cash. So there's billion-dollar office buildings now. Not many people have $1 billion sitting ready to go to buy a single commercial real estate asset. So that brings up point number 2. Let's say I have that $1 billion. Am I going to put it all into one building? That's not terribly good advice. So we've all learned about portfolio theory and diversification. So if I had $1 billion, and some real estate investment funds have more than $1 billion, well, they're going to distribute that among a whole portfolio of assets using debt and other types of financing so that they can be diversified and all their investment capital, all their powder is not in one single asset. I'll skip to number 4. So number 2 is an incredibly important reason why investors take on debt. Number 4 is the other reason. Debt is a way that investors can alter the risk that they're taking in any commercial real estate investment in exchange for the expectation of perhaps higher return or lower return, depending on if they're risk-seeking or risk-averse. So a risk-seeking investor can take on lots of debt. By taking on lots of debt, they have low priority to cash flows, as we'll learn later in this short video. With low priority to cash flows, they have higher risk, but we're also going to learn that they will be able to earn 100% of all the excess cash flows. So their upside risk, their upside returns can be quite high. And we'll show that they don't have to put a lot of capital in there to get lots of returns, but because the less capital they put in, the less exposure or the less priority they have for cash flows, they have a higher risk. We'll talk later on in the course about the relationship between debt and financial risk. But suffice it to say, more debt, more risk. We call that leverage. So we might want to take on more debt to leverage our equity capital, take on higher risk in exchange for the probability or the possibility of higher returns. So key thing here, real estate is a capital intensive business at the start. We need lots of money right away. Debt is often the first place we look to go find that money. So what does debt work? When we take on debt, what does that mean? Well, I like to think of debt as another real estate investor that we're bringing into the deal. So don't think of debt like a bank or some third part, some source of money. The capital from the lender, from the source of debt, is an investor in the same piece of real estate that you're going to be investing in. They're just simply investing in a lower risk, more secure position on the capital stack, which we'll talk about in a second, in exchange for priority. They want the first priority to all of the cash flows and the receipts from the sale. Once that debt is paid in full, then the equity investor receives all of the additional income or receipts from the sale. And what that means is that we never pay our lenders more money because we made excess returns. If we make excess returns, all of those excess returns accrue to the equity holder. And we'll talk in another video about debt also gets the right to foreclose. So they kind of have a gun to our head. If we don't pay them, they can take the asset because that asset is collateral against the loan that they're making. So this is the capital stack. Key thing to take away from this video. On the left here is the equity. Until now, we've been talking about buying a whole asset, and our returns are exactly equal to those that we found in the NOI cash flow, right? Net operating income is our net cash flows for the income, and when we sell the building, the reversion, we receive the whole sale proceeds as our income. So that's the scenario. If you've got all cash to go in on a building, you are the entirety of the capital stack. Not a typical capital structure for most real estate investment deals nowadays. We need lots of money. So the way we take the same assets, and nothing is going to change about the inherent productivity or returns from the same asset. So in my example, which I'll talk through, let's just say that equity stake, unleveraged, 100% cash, has a 7% internal rate of return. So a 7% return, all cash. What I'm going to do is take that same 7% return and split it up into two investors, my equity investor and my debt investor. In exchange for getting it on the deal, I'm going to give that debt investor first rights to all the cash flows coming from the deal. And then when they are paid off, and this is their service payments, their monthly payments, and the principal remaining if and when I sell it, that's their entitlement to cash flows. Once that entitlement has been met, all of the additional returns go up the capital stack and accrue to the equity holder. So because of the priority, I've now got a different risk exposure based on the investor. The debt investor with the high priority, the first priority, they're in a much lower risk position. So if they're taking on 60% of the investment and returns fall 30% below expectations, they get 100% of their return because they get the first 60%. Right? In that case, the returns were 70% of expectations, 60% less than that, they're fully paid off. Equity, on the other hand, put in 40%, but they're going to take all of the losses, 30%, and just get a 10% of what they expected in return. So because of that low priority, the equity holder is taking on lower risk. And my example, so we can have one asset earning 7%. If my debt holder takes 60% and they put 60% of the capital to invest, and because they're lower risk, a competitive market would say, hey, you get 6.5%. And at the same asset, if this asset earns 7%, the equity holder takes 40%, their total return is 7.75% return. So you can do the math. 40% times 7.75% plus 60% times 6.5% will equal a 7% total return. Now, when we get deeper into this course, we're going to break the capital stack into a few more pieces. We're going to have both senior debt, which is debt with the right to foreclose, and junior, or the jargon is mezz debt, which is unsecured liens, but they are treated like debt cash flows. And the key difference here is that debt cash flows don't get excess returns, unless debt can be structured that way, but no excess returns for debt. Preferred equity. These are outside investors that don't have real estate expertise but want exposure to equity investment in real estate. They do participate in equity returns. It looks a lot like unsecured debt. You pay them off a coupon first. They get a certain first priority over the sale proceeds before the common equity or you, the sponsor, gets the money. But they participate in excess returns. Now, common equity is you, the real estate expert. You're the one putting together the deal. You're managing the investment. You're making the decisions. It's natural for you to sit at the top of the capital stack, lowest priority. Why? Because you have the strongest incentive then to deliver those excess returns. So higher you sit on the capital stack, bigger the incentive for you to make the property produce what you promised to your investors below you on the capital stack. Also to produce excess returns. Later on we'll talk about waterfalls, which is where the equity stakeholders share in those excess returns. So key thing from this, priority differentiates investors, allows them exposure to the asset risk in different levels. So the lower you sit on the capital stack, the less risk you experience because the higher priority of the cash flows. Competitive market will bid up the price for those stakes, which means your expected returns go down. So you get lower returns, lower risk. Higher up on the capital stack, you get low priority, higher risk of not receiving your expected returns, but big upside potential in the accrual of excess or over capital returns. So higher expected rate of returns on the top, lower on the bottom. Thanks for watching.